certifications when it comes to finance. At the time, I had read about how the CFA programs equips you with the needed financial skills. So it was a no-brainer. I needed to get to the CFA and to excel and push my career to the next step. The CFA program is a challenging program, but I failed the level 1. I didn't relent. I learned about patience. You need to put in the work, countless number of hours, and then having the dedication to continue through with it. It also taught me about humility. I mean, the vastness of finance. Even though I had the experience, I realized that there was more to finance, and the CFA really equipped me in that aspect as well. In the ecosystem in Ghana, we face a demand and supply problem. So the demand for capital by these entrepreneurs is so high, whereas the supply of the capital is low. And so from the onset, you need to do rigorous investment analysis. You need to do rigorous due diligence. And the CFA program prepared me for that. How do I allocate scarce financial resources to the right entrepreneurs and to the right areas where we can have the proper impact, and then helping these companies to grow. And when they grow, they contribute to the climate change mitigation, they contribute to climate change adaptation as well, and then they contribute to social impact, which is job creation, improving the income and the livelihood of poor people. And these sort of tie into the sustainable development goals. So the transition from asset management into impact investing and venture capital was a pivotal one for me. In asset management, I did a lot of investment analysis. The whole idea was, how do you maximize return? In impact investing, the whole idea is to be able to do all this, have a base of ethics. And this is what some of the things that the CFA program equipped me with. In my line of duty on a daily basis, I apply a lot of ethical principles. When I'm doing due diligence, when I'm analyzing a company, an individual or an entrepreneur, these are things that I really apply a lot. I would really encourage aspiring CFA candidates to never give up. Embrace failure as part of the journey. It is difficult, but the question is, what do you do after the failures? Pick up yourself, identify areas where you can improve, and then you continue. You just keep going, and you're going to make it. And you will see the impact.
I'm beaming with smiles. It's an interesting video. Thank you, everyone, for joining. I believe we can begin the session now. So I'll start by saying good morning to everyone, distinguished colleagues, fellow CFA members, and to our panelists, Mr. Matthew Bwedweje, Ms. Enyonam Kakani, and Mr. Percival Ofuriampoma, whom I gladly call my boss. It's a pleasure to welcome you to today's webinar on unlocking pension capital for growth. I'm really looking forward to this conversation. Anytime we put CFA minds, pension trustees, and private capital people together, the GDP of Ghana should at least move a few basis points by the end of the session. Now, over the past decade, Ghana's pension industry has grown into one of the strongest pillars of our financial system. Following the 2010 reforms, pension assets have expanded from under about 5 billion in 2012 to about 90 billion today, which is about 7 billion USD, and contributing to about just 10% of our GDP. But while the capital base has grown, its deployment has not evolved as much. Nearly 3/4 of the pension assets remain in government securities, delivering safety but limited transformation. And that's what brings us here today, to explore how this capital can build the productive economy of the future, the economy that we all want to see. It's worth recognizing, however, that real progress has been made. So the Venture Capital Trust Fund, VCTF, and its partners have helped anchor about 11 funds with close to about 29 million USD. And they've leveraged this 29 million to actually bring in an extra about 100 million of private capital. Pension funds themselves are beginning to take deliberate steps. So between 2022 and 2023, Local schemes committed roughly about 15 million into private market vehicles, including anchoring positions in the 260 million in Jaro Ghana Venture Capital Fund, where Ghanaian pension schemes collectively invested about 11 million USD. Our panelist institutions have also contributed to this shift. So we have Oasis Capital under the leadership of Matthew Boedwe, securing pension participation in Oasis Africa Fund 2. Mrepa Capital as well, under the leadership of Enyonam and the team, have also mobilized pension commitments into Mrepa Capital SME Fund 1, I think. VCTF actually invested in both funds, in both teams, by the way, and they continue to do more with the industry. And this is under the leadership of my boss, Percival. Beyond the capital, they've also trained pension fund trustees. They've trained fund managers, VC analysts, the fund management teams, and they've done quite a lot to actually build confidence and capability in the industry. So we've come a long way from the days when venture capital was considered too risky to mention in the trustee meeting. But we've come a long way, and we're grateful for that. But where are we at the point where we want to get to? So we see the industry, the VC industry in itself has also evolved over the years, and the data gives us a fascinating reality check. As of 2023, the private equity and venture capital industry managed about 6.9 billion in assets across 72 funds. Now, on paper, that's impressive, but here's the catch. Nearly 80% of that capital is foreign and regionally managed, lots of them domiciled in Mauritius and South Africa or Europe, with Ghanaian funds contributing only about 2.4% of total assets. So on one hand, we have lots of pension money, we have the VC industry that's ready to receive that, but we see a lot more in terms of foreign funds actually coming in to enjoy the benefits. In other words, Ghana is rich in deals, but we are poor in domestic ownership. This means that the value created by Ghanaian entrepreneurs, it often flows to external LPs, not inward to Ghanaian retirees, workers, or citizens. So if there's one call to action today, it's this: we must localize the ownership of our growth story. We must localize that, and we must own this story, right? And pension funds actually represent the most strategic source of local capital. They are long-term, they are patient, and they are regulated. And this is exactly what private markets need. But beyond the returns, it's also about economic sovereignty, right? When Ghanaian pension funds invest in Ghanaian private equity and VC funds, we achieve a few things. We keep more value in the domestic economy. We align national savings with national priorities, in that we want to industrialize, we want to achieve our green transition, and we want to grow SMEs or the informal sector. But we also build a sustainable capital market that is less dependent on external cycles of aid and grants or global investor sentiments. And other countries are doing it. We see examples in South Africa, we see examples in Nigeria as well, where they have actually properly deployed pension money to actually grow to a large extent their economies. In Ghana, the Pensions Act already permits up to 25% of pension assets in alternative. And it's one of the most progressive on the continent. But current allocations is still under 1%, right? So the opportunity isn't to add risk, but it's to add resilience, to let our long-term savings build our long-term growth. And we are fortunate to have with us three people at the heart of this evolution and at the heart of this growth story. Again, I spoke about Mr. Boedwe's fund, Oasis Africa Fund 2. And this fund has shown that local capital can responsibly fuel high-impact enterprises. The same can be said about MREPA, SME Fund 1, and it has demonstrated that women-led impact-driven funds can actually attract institutional capital. And with VCTF and the amazing work they are doing, they have actually shown that they've built the institutional backbone for this ecosystem. So we have the right people to actually undertake this discussion. So as we begin with the dialogue, imagine a Ghana where our pension funds finance our own entrepreneurs, our SME skill using domestic savings, our capital markets recycle local value and not export this local value. Suppose we can even move a small fraction of our pension assets safely and strategically into well-governed local funds, VC or PE funds. In that case, we can shift the center of gravity of Ghana's growth from foreign capital to domestic ownership. And I believe that this is not just a financial strategy, it's a national imperative. And with that, I am excited. It is my pleasure to hand over to our moderator, Stanley, and he will guide us through what promises to be an engaging and forward-looking discussion. And I look forward to all the insights that will come up. Thank you, and over to you, Stanley.
Thank you, Isaac. I think that was a very insightful background, which I believe set a very good tone for our discussion this afternoon from Kenya, and then this morning in Ghana, and maybe evening to you, wherever you are joining from. So thank you so much, Isaac, for that insightful background. And we are really happy to see you doing very well, the CFA charter, which is been a very good motivation for our colleagues who are also interested in doing same. So thank you. We wish you all the best. All right, so you're welcome, everyone, and this event promises to be very insightful. I mean, it's a program that I believe is very pivotal as far as our pension industry or pension landscape in Ghana is concerned. And the focus is for us to be able to see how best we can unlock the pension capital that we have in Ghana for growth and realigning or align investment strategies, with Ghana's economic ambition. And as I actually peeped into the profiles of the speakers or the panel members for this event, it's quite critical that they've been very useful as far as the industry is concerned. So without much ado, I would want to introduce our speakers for the event. And these are very experienced industry brains, which I believe that we can't talk about private equity, venture capital, and pension industry without reference to the contribution as Ike intimated in his background. So let me just provide some introduction to our speakers. Then we can start with the discussion. So the first person I'd like to introduce is in the person of Percival Usu Ampoma. He is a multi-jurisdictional investment and legal professional with over 20 years of experience in private equity, venture capital, asset management, and corporate law in Ghana, in the UK, and even in the US. He is currently the general manager for Venture Capital Trust Fund, company he served as the head of investment before moving on to serve as general manager for private equity, Ghana Growth Fund, and then move on to be a founder and a managing partner for Value Lead Advisors. And then he's back again into the same company, Venture Capital Trust Fund, now not as a head of investment, but as a general manager. He holds BSc from the best university in Ghana. I know others will argue in electrical and electronic engineering from KNU University before moving on to do LLB from GIMPA, and then professional law certificates from Ghana School of Law. He holds masters in finance from Durham University in UK and executive education, private equity, and venture capital from Harvard Business School. So this is a very experienced brain as far as private equity, venture capital, and asset management concerned in Ghana. First of all, you're welcome.
Thank you, Stanley. Is it Stanley, right? Stanley, my name is not Owusu Ankoma. It is Ofori Ampoma.
Yes, Percival Ofori Ampoma. Thank you for the correction.
Thanks.
Okay. All right. So without that, let me move to the second speaker for this event. Another very experienced industry brain, and he is in the name of Matthew Wedu Eji. I hope I get that right. Matthew is a founder and a CEO of Oasis Capital Ghana Limited, a private equity fund management firm based in Ghana and Cote d'Ivoire. and he focused on SME in West Africa. He has over 20 years of investment banking experience, and 21 years of which he has been working in the venture capital and private equity industry across Africa. Proud to establishing the Oasis Capital Ghana in 2010, he was a country director for Growfin Ghana Limited, which is a Pan-Africa SME development and finance company that has operation in 8 African countries. He also was the member of the investment committee of the Growfin, a fund that managed over $170 million SME fund based in Mauritius. And he was involved in the review of transactions from several countries in Africa, including Ghana, Nigeria, Rwanda, South Africa, Tanzania, Kenya, and Uganda. And before he actually joined Growfin in 2008, he also served as the investment manager for Fidelity Capital Partners. Matthew holds BSc in banking and finance from University of Ghana Business School, and also MBA from Leicester Business School, the Moffont University, UK. Matthew, you're welcome.
Thank you.
Okay, so let me move to the last person, who is the only female amongst the panelists for our discussion. Another very, very experienced mind in the industry. In the name of Enyunam Kakene, she is the executive director, Impact Investing, Mirepa Investment Advisors. She also served as a general manager for Atlantic Computers and Electronics, and also a co-founder of My SME Portal, which is but My SME Portal is a company that tries to connect investors and SMEs to investors and enterprise support providers. She holds BSc in computer science and statistics from University of Ghana, Legon. So she has, very extensive experience as far as a private equity venture capital is concerned in Ghana as executive director for Impact Investing, Mirepa Investment Advisors. And you're welcome.
Thank you, Stanley. It's a pleasure to be here.
Very good. So I hope you're actually ready for the main discussion, and this is going to be very insightful. And Isaac gave a very good background as to how the pension industry is doing in Ghana. So I would just want to set the context with the first question, which will be going to all the 3 members of the panel, and just to pick your thoughts on that. And it's just to reference what Ike mentioned, that currently we have about 90 billion assets in the pension industry, growing from 45 to 61 billion, and now 90 billion, out of which we have 65 billion Ghana cedis in tier 2 and tier 3, and about 25 billion in tier 1 capital, which is managed by SNE. So I think the focus now will be on tier 2 and tier 3, about 65 billion Ghana cedis. Now, the question that I would want to ask Percival first is, how important is this pension fund in the scheme of things as far as Ghana's growth is concerned?
Well, thank you, Stanley, for the question. And Isaac, thank you for the background to this. How important is this money to Ghana's growth? Well, let's think about it in terms of numbers. When we did research several years ago, we came to the conclusion, based on a Boston Consulting Group research report, that the annual requirement for funding long-term capital, patient smart capital, was in the region of $15 billion per annum. This figure is how much money Ghana really and truly needs if it is to be serious about investing in local industries and moving Ghana's economy forward to the level that we all want, in respect of, for example, GDP growth, innovation, technology, job creation, and the rest. 15 billion is the gap. And what we have today, we don't even have 1 billion, going towards long-term funding to SMEs. And here we have a pension fund that is growing on an annual basis. Currently, we are at 90 billion. What that means is that if we are really truly to ourselves channeling this 25% of pension fund assets into the SMEs, it means that we would at least make a dent or at least contribute to this, close this gap, so that our SMEs would be well positioned to compete first on a national level and then on a global scale. There are significant opportunities emerging out of, for example, AFTA, where Ghanaian companies can now be positioned as regional champions. And they will be producing in Ghana and sending it across the country, across the regions, West Africa and the whole of Africa. This is a huge opportunity that we have as a country, and we cannot take that opportunity with companies that are deficient in capital. So in terms of economic growth, that money which currently sits with pension funds is a significant opportunity for us as a country to use that money and transform our economy by converting that money into companies, or giving that money to entrepreneurs that would turn this money into useful, productive services and products that everybody loves. And that would then generate returns for the pensioners themselves, of course, and for the other LPs, institutional LPs like ourselves, and for the companies themselves and the entrepreneurs. But more importantly, the impact that it creates, the jobs that it will create, the technology that we hope to see, the innovation that we hope to see. So the money in really and truly is a significant opportunity for us. And I hope that our conversations will lead to more allocation of capital to the VCPE industry. Thank you, Stanley.
Thank you, Percival. I think that's a very, very insightful point. So I'll be going to Enyunam. Listen to what Percival has mentioned, that the pension assets in Ghana is very pivotal as far as job creation, technology, SME growth is concerned. Do you think that the fund as it stands now is well positioned to achieve that goal, or those benefits that he mentioned?
Thank you very much. Yeah, so to piggyback on what Percival has shared, as he said, if we want to see real growth, then it means that we need to be looking at, investing in the productive sectors of the economy, and that is where the growth that we expect to see would happen. And so investments that are going into education at all levels, infrastructure, especially when it comes to the agric-producing regions, for instance, the connectivity between those regions and other places, things that would facilitate and improve trade within the country and also with other markets as well. These are the things that would spike the growth that we expect to see in our economy. And as he said, the financing gap is so huge, and directing investments towards that would actually drive down the cost of doing business within the market, and you will see that our market becomes more profitable and sustainable as well. In addition to that, also, we also want to see the entire industry develop. And so more investments going into the alternatives or into the private equity space would bring about a continuum of investments, which is what we see in other developed markets. And so we would see that there are different strategies that are aligned with earlier stage businesses, growth businesses, more mature business, so that we can actually see our companies grow along the way to become the champions that we see in other places that we admire so much.
Thank you. And that's also a very good addition to what Percival has mentioned. So, Matthew, I know you have a very extensive experience within the pension space. Do you also have any points to add to what the two of them have shared?
Okay. Thank you, Stanley. I share a similar view, where pension is a long-term capital. For that reason, it's an opportunity for us to use the long-term capital to support the growth of our SME businesses. But beyond that, it could also be used quite extensively in the development of our own infrastructure, particularly social infrastructure. We can leave the bigger ones because for government to do, but there is a significant role that we can play, and which have been done in other jurisdictions that can also help generate continuous return for the pensions and at the same time for our national development. It could also be used as a very good source for deepening our capital market itself. We got MTN listed, they pay generous dividend and they take the money to SA. If we had substantially invested in that, the bulk of that money will remain. And in our practice, we've seen instances where foreign companies have come to Ghana, they want to exit, and then the business gets sold to other foreign group. Whereas the management team could be supported with this capital to acquire the business, the capital remains here, and the wealth and benefit inure to Ghanaian. So we see a pension capital as a good asset class that can help support the development of a nation. And as a consequence, when that happens, it results in employment generation, and that fuels the sustainability of our own country. Thank you.
Thank you so much for that addition. That's a good one. So I think, so my next question, which I'll bring it to Matthew again, is on the structure of the pension assets we have in the country. As we just mentioned, that the pension industry is very pivotal to the growth of the country, and if we can really reposition or position the asset very well, especially in the area of agriculture, technology, as rightly mentioned, we'll be able to unlock the potential that we want to see in the country, or which are actually hidden in the pension space. However, if you look at the current allocation of our pension assets in Ghana, it's quite clear that in 2023, we have over 82% allocated to government securities, and then also about 72% allocation in 2024. So there was a slight decline from 82% in 2023 to 72% in 2024. I mean, which is giving some hopes, right, that there's a reduction in allocation to government-related securities. And if you look at Africa, we have over $22 billion, assets, or pension assets allocated to government-related securities. Now, I want to ask you, do you think that the structure as it is now, where majority of the pension funds are really allocated to government securities, is a good structure? What is your take on the current structure? Is it sustainable, and will it deliver the growth that or the benefits you want to see within the space?
Thank you very much, Stanley. Yeah, the allocation is not surprising. You have to bear in mind that the pension sector was privatized only in 2010. Prior to that, it was SNIT that was leading the charge, and it was seen and still seen as a quasi-government entity. And therefore, there is some kind of government influence to some extent in terms of asset allocation. So even coming from the background, when the law was promulgated, there was a thinking around, and there was at the initial stage, there was inertia as to whether we should allow even private participation. So from start, the assets that were available that were considered safe and secure were government papers. So every asset manager would want to take that ride, and then had some limited allocation to the stock market. I think with time, the law allowed some participation of alternative, but the asset have not yet been allocated because people need time to learn, to understand, and to appreciate. And the decline in the government paper allocation is very clear that it is as a result potentially from the debt exchange program. I think prior to that, people had come with the illusion that government is the best creditor, and therefore it's a good asset class. Nobody anticipated that there would be difficulty for government to pay, because we had come under the illusion of government can, in a worst case, can still print money. But we forget that there are also laws that forbid government from printing money, and there is a extent to which government can print money. So for that, and government cannot also continue to print money because it may also have inflationary effect in our society. So with that experience, people then began to realize that, okay, on the basis of this, let's look out for other assets. And that is where we began seeing some asset allocation into the alternatives. Of course, before that, the first private pension allocation to private equity was done in 2017. An amount of about $5 million. And today, we can safely say that there is more than $25 million that have been allocated into the private equity sector. And that is a good step. So we believe that with time, there will be enough opportunity and there will be enough asset class for the managers of pension funds to diversify. Because even if today they decided that they would allocate the assets to PE and other alternatives, where are the assets that they are going to? Where are the instruments? So the market will require time to develop and evolve. And I'm sure that as we begin to show and demonstrate return on sustainable basis, and to demonstrate that you can invest in SME and exit and post a very decent return, I think naturally we will begin to see more and more allocation to the particular sector. Thank you.
Thank you, Matthew. I think that's a very good point you raised. So I want to just follow up with the question again, because you referenced the debt restructuring, which commonly people call haircut in Ghana. And I know that seems as a bad news for those of us who actually invested and then got the haircut. But it seems the haircut that we had is beginning to set a tone for a reallocation away from government securities. Is that the case? So is there a good news in the debt restructuring we had in the country?
I wouldn't say it's a good news when somebody has lost money. I'm sure if you did lose money, you wouldn't be happy either. And even if you lost the opportunity to have your money when you needed it, for those that postponed it, you were still not happy because you invested with a plan. So that cannot be said to be a good news, but it's a lesson. And in life, people learn. So having learned that, now we have put to rest the illusion that government can never default. So now today we know. But people, the asset will still be allocated in or have already been allocated in government papers. It will require time to gradually slow down those allocation and look out for alternatives. It is an opportunity for market makers, for us to begin to realize that now there is opportunity for us to create assets that are sustainable, assets that are impactful, and assets that can result in continuous return. And I think that this is the best opportunity for us. Having learned from that episode, today we have a better opportunity to do that. So obviously, yes, would people have allocated to alternatives if that incident had not happened? I think yes, but probably would have been much slower than it has been. So it certainly serves as catalytic to that. So we hope that we will be able to diversify and grow multi-asset classes in the country so that the pension fund managers would have a good alternative to consider. Thank you.
Thank you, Matthew. That's a good point about that. Because I personally believe that as of now, the perception of government being risk-free has been disputed. And we see examples from Ghana, Zambia, even Niger. So that's a good point. Okay, so let me now move back to Percival and then and I'll be starting with Percival on this about barriers to diversification of our pension funds in Ghana. And when Isaac was giving the background, he mentioned that we have 25% regulatory allocation to alternatives. And then recently, I think in July 2025, this year, there was a directive by government where they are allowing 5% allocation from pension funds into private equity and venture capital in Ghana. However, as of now, we have only 1.1% allocation of pension funds to PE and then the VC space in Ghana, and with 0.5% allocation to private equity in Ghana as of now. And if we are able to do a 25% allocation, we can unlock like $1 billion placement within the VC and the PE space, right? Just alone. And if we go by the 5% that government recently gave, we can unlock about $200 million in that space. If you look at countries like Botswana, they have 3% allocation to alternatives. Lesotho, 3%. South Africa, 3%. Nigeria, 3%. Zambia, 10%. Very impressive. Zimbabwe, 3%. But it seems the allocation that we currently have in Ghana are 1.1% in alternatives, and then 0.5% to VC and P. It's relatively low if you look at it. I mean, in respect to the other countries that I just mentioned. What do you think is a challenge, or is a challenge for the fund managers in the pension space to allocate their funds within the VC and the PE space? So, Percival, I want to take this from you first before anyone follows.
Well, thank you, Stanley. So it is a loaded question, and I'll try to break it down. You see, Stanley, what could be the problem? Is it regulatory? Is it perception? Is it skill set? It's a combination of all. You see, I think I wanted to add to Matthew's submission on, whether or not where the opportunity comes from, whether or not the allocation that we have currently from the regulator is really fit for purpose. As you know, before this 3-tier pension scheme was actually brought to bear, there were a lot of collaborations and thinking around what we can do to mobilize long-term savings for the purpose of generating economic growth in the country in the first place. So, ab initio, the whole reason for going 3-tier pension scheme was for the purpose of generating long-term money and directing that money to the productive sectors of the economy. And so that was the idea. And I can tell you, the same year that the Pensions Act was passed was the same year that the Venture Capital Trust Fund Act 2004 was also passed. And the reason for that is not an accident. They actually deliberately decided to do that so that the Venture Capital Trust Fund can then use that long-term money to invest in SMEs for the long haul. So it was the original design. It was only in 2010 when the actual operational thing started that we realized there was a huge gap in the knowledge that people had about the asset class. You couldn't blame them. Private equity and venture capital was considerably new at the time, and people were still getting their feet wet in respect of what the asset class looked like. And I remember in those days when we were having seminars and advocating for pension assets to be allocated to private equity venture capital. The common narrative was that, this is quite opaque an asset class. It is risky. We don't understand. And I remember having conversations with Matthew in those days, and we were wondering, so if you say just because a company is private, it is highly risky, and a company that has gone public is not necessarily so. Could you compare, for example, Stanbic Bank, which is not listed on the Ghana Stock Exchange, with a company, I do not want to mention names, but any company languishing on the Ghana Stock Exchange as that company being less risky than Stanbic? The understanding that an asset class is opaque and private and therefore highly risky has driven us from that 2010 idea to be so risk averse that we did not want to follow through with the idea that originally gave birth to this 3-tier pension scheme, which was that we mobilize long-term money and direct it towards the productive sectors of the economy. So the knowledge gap was serious and it was there. And over the years, we have tried to bridge this knowledge gap through capacity building programs. Last year, for example, we did venture capital, did a lot of this. We trained almost all the investment committees of the pension trustees. We trained the CEOs and the COOs. We trained analysts, and we're doing so much in that regard to bridge that gap so that we can all appreciate what the asset class looks like. So that knowledge gap has contributed to this, should I say, jaundice approach or jaundice allocation to the asset class. Now, it was quite refreshing to see that finally, after 8 years of trying to change the mindset, we managed to move from 2% allocation to 25% allocation. As Matthew has said already, it takes time for us to learn some of these things. In fact, if we had taken this positive approach in 2010, perhaps by now our asset managers and the pension trustees would have gradually bridged the gap much faster and would have been seeing perhaps a different Ghanaian economy. But it's not too late. Now we have 25%. Knowledge gap is serious. Is it regulatory? Yes, I have been at the forefront of training NPRA staff for some time, and I could understand, their apprehension when you are vested with the responsibility of guaranteeing the integrity of a financial services industry, particularly as pertains to pensions, which is a very sensitive area for many people. You can be forgiven for being a little risk averse when it comes to an asset class that you have no idea about. So the regulators themselves take a considerably conservative approach. But in the last couple of years, we have seen that approach is loosening up and welcoming to the idea that, look, if we do not diversify, we cannot continue to give all our monies to government and wait for the next 10 or the next DDP to come and sweep our monies away. So the knowledge is the knowledge is coming, the understanding is coming. And now the collaboration within the industry is also coming. When it started, asset managers were scared to actually even consider. As Isaac said, you wouldn't even bring up discussions of private equity in the investment committee. Nobody would listen to you. And I had, very interesting experiences when I was training some of these people in Koforidua. They simply did not understand. And there was a lot of misconception about the asset class. So that knowledge gap has played against us a lot. Now we are trying to bridge the gap. And if you were to ask me the most significant impediment that has caused us, not to be able to allocate all this 25%, it is that knowledge gap. And thanks to the works of Matthew, of Enyonam, of Repa and Jaro, VCTF, and the Ghana Venture Capital Association in general, we are trying to bridge this knowledge gap. And in doing so, we have seen that we are moving forward. What I think would be good is that those pension funds who have originally made allocation will now begin to tell the story of how successful those investments have been. And that will take time. But for now, I think that the knowledge gap is the number one significant impediment to us getting, that significant allocation into the asset class. When it comes to regulatory impediments, I mean, of course, we have all our challenges with, SEC and how it regulates PE industry. But in the large scheme of things, when compared to pensions, it's not as significant, in my opinion, in my honest opinion. It's not as significant as the knowledge gap. Because, when you sit at the investment committee and you are making an investment, I had one of the fund asset managers talk to me and say, you know, Percy, we spent about 2.5 hours just going through an investment opportunity to these IC members, only for them to say, we hear you, but we want to stay with government bonds. Clearly, the knowledge hasn't gone down well. So Stanley, if you ask me, that knowledge gap is a critical component of why we haven't been able to bridge, we haven't been able to allocate more. But I think that what is going on now looks positive. And in that regard, I think I'll lean towards what Matthew was saying, that with time, when they are able to learn and recognize that there is success in investing in this asset class, we should see that that allocation move from that 1% to 5% to the 10% that we are all expecting. I cannot tell you when, but I can tell you we are working very hard at Venture Capital with our partners to make sure that we increase that significantly. Thank you, Stanley.
Wait, thank you, Professor. That's a very elaborate one. But I have a follow-up before I move to Enyunam. So I believe that in the pension space, most fund managers are looking for good returns, right? But then within the space of venture capital, private equity, you're also looking at impact. So how do we bridge that gap between return and then impact?
Well, Stanley, that's a very good question. So you always, and when we talk about this impact, you always have to place it within context. What exactly is impact? Are we talking about? In Ghana, our number one problem is job creation. And many people don't have jobs. Our unemployment rate is considerably high, and our companies are not having enough capital to scale up. So even if you were to look at job creation as an impact measure, then all of our investments, our fund managers are actually driving this impact. Venture capital over the years has created more than 30,000 jobs, direct and indirect, and has impacted more than 2 million people. But has that led to us not getting our money back? Certainly not. The fund manager that actually focuses on generating impact is the same fund manager that is also mindful of his contributions towards the society. So if we even define impact as being a positive member, a positive citizen as a company, a positive citizen of your community, then in driving that social capital towards yourself, it is actually a value-adding proposition and not a value-reducing proposition. So the focus on impact, from our perspective, does not take away the opportunity to generate returns. We have been at this business since we started 2006. This year, we published our 20-year annual report. And in that allocation of capital, we have had several successes of companies that we have invested and exited successfully, with impact still being generated. So I do not see, a bifurcation between impact and generating returns. If you were to define impact from the ESG point of view, you will notice that the obvious or the most prolific observation is that if you focus on ESG and you use ESG as a value-enhancing tool, you actually stand a better chance of improving your business and therefore a chance of making your financial return as you set out to do. So ESG, again, does not negate the idea of making financial returns. So, of course, the pension funds that invest primarily because they are also looking for financial return, they will be skewed considerably towards making sure they generate the returns. But think about it. If because of that, you put a company, a fund manager, you push a fund manager to go and invest in a mining company that's involved in Galamsey, what would be the impact on a pension fund which has invested in a company that's involved in Galamsey against the impact that you would have driven if you had actually avoided companies that are deliberately destroying the environment? You can see that there is some positive out there. So even though you may not go out there and invest in a company that is polluting the environment, you might still find companies with your lens of ESG, find companies that could still generate the returns that you need, but also focus on impact. So I think the focus on impact doesn't necessarily negate return expectations. Some may argue that, well, there's some impact there, but from my point of view and from the experience we've had at venture capital, that is not the case. You still can generate decent returns when you focus on the impact, if you define what impact parameters are relevant for the economy.
Thank you so much. We also pray that we connect with the videos as well, so that we can actually see our speakers going forward. Okay, so, what do you think are the limitations that are hindering people from allocating to the VC and the PE space? I know Peswa has mentioned a lot. Do you have any thoughts to share as well?
Yeah, so I do.
And if you can kindly turn on your video so that we can actually connect with our speaker.
Okay, let me try and do that. I realize that once I turn it on, I tend to lose, or my connectivity becomes a little problematic. But yes, let me turn it on. Yeah, so I do share and agree with what Percival has talked about, both on the regulatory and the education side. Yes, so just to add to what he said, that the trustees do need to see some more success stories coming from the industry. And there are actually some trustees who have also benefited from, private equity investments in the past. The examples that you can look at. So these are success stories that can be shared. And then we as an industry also need to be telling, these stories deliberately, intentionally showcasing what is being done on the ground to the trustees. So, for example, at MEPA, what we have started to do is to actually take the trustees along with us to the visits that we do to the portfolio companies or to our investee companies, so that they get a first-hand experience of what the money that they've been entrusted with, the funds that they've been entrusted with, is actually doing, in the lives of real human beings, real people, real families, and businesses as well. And that way they get to connect better with, what we as a company or as a fund or an industry is trying to do, what we are trying to achieve, and what the impact is in terms of the jobs that are being created, um, beyond just sending them, the reports which they can review and all that. We also take them along so that they have that first-hand experience, and that really goes along them to appreciate what we are doing. I hope you didn't lose me.
We lost you briefly, but I think we heard what you were trying to say.
Oh, I'm so sorry about that.
Okay, so thank you so much for that also insightful addition to what Percival had mentioned. So I want to move back to Matthew, and I also pray that you turn on the video as much as possible if you can. And just, I think you actually hinted on this earlier, but I may just a brief one on this point. We've seen that the pension industry in Africa has about $22 billion, and then it's projected to be $7.3 trillion by 2050. And Ghana has demonstrated a sign of a reduction in allocation to government securities from 81% to now around 72% 2024. Maybe this year, maybe within the 60s, possibly, we hope so. But do you think that the mere fact that there's a reduction in the allocation to government securities is a sign that we are beginning to appreciate diversification, maybe to VC and private equity?
Thank you very much. Thank you, Stanley. I think you hit the nail right there on the head, because prior to the episode, the conversation around in 2023 and 2022, where Ghana had some challenges, and which resulted in government defaults, I would say. Institutions we were struggling to get the mindset of asset allocators to look at different things. But that triggered the awareness and the need to explore alternatives. But as I said earlier, developing alternatives also would take a bit of time, because if, let's say today, the Pension Fund Association decides that we want to allocate 10 billion to alternatives, which instruments are they going to put the money in, right? It will take a bit of time. So as the market is evolving and developing, we are also developing new products, new infrastructure products are being developed, technology. People are also developing private equity, venture capital, or offering some alternatives. And even within the same space, with everyday person, we're investing in businesses. Some of them then become real to people, that they are tangible. When you mention the name of the company, people know that, oh, this one was also private equity, right? In the country, many people may not be aware that institutions like Car Bank, EcoBank, Legacy Girls, Vortic, and the list continuing to go on, have once a term received private equity capital. So with time, we will begin to appreciate and even see some of the institutions that private equity have founded to be listed on the stock market. And as it becomes familiar with that, you begin to see people leaning towards diversifying their asset allocation. And I'm sure we would also have sufficient data at the time to back any analysis that will be done by the asset allocators with the passage of time. And of course, that would then begin to also teach government the need to be a bit more disciplined. But if government continues the same tangent and trajectory, then they would have a potential failure again in the future, which may even reinforce the thinking around the need for diversification. So diversification is certainly necessary for every experienced asset allocator would like to diversify, because you don't want to put all your eggs in a bucket, because if something happens, then you are gone. Yeah, you can see that the reduction is quite significant in terms of relative, from 82% to 72 means the initial reaction. And with time, people make real decisions to diversify. And we're seeing that progressively coming to pass, that people are looking at new assets, new opportunities. People are looking even into our stock market. This year, if you look at the Ghana stock market, we've done extremely well. Why? Because people are looking for options on the Ghana stock market. And that is why demand and supply is pushing prices up. Thank you.
Thank you, Matthew. First of all, let me come back to you. And it's been quite clear that the inflow of funds into Africa, especially into the private equity and the venture capital space, has been declining. And in 2022, we had about $4.9 billion, and then that came down to $2.2 billion a year later. And Ghana had actually received $1.2 billion from 2014 to Q1 25, about $0.5 billion into VC, and then $0.7 billion into private equity. So in all, $1.2 billion. But generally speaking, there has been a decline in the numbers we see coming to Africa. I want to ask what you think are the reasons, accounting for this decline in the inflow of funds into private equity and the venture capital in Africa, and what you think about the role of Ghana's pension industry, the role they can play to bridge that gap in the decline we are seeing on the continent.
Well, Stanley, thank you very much for that question. You know, Stanley, the challenge that we all face is this, that I hope my video is okay. That the light
Yes,
is
I can
not
see you very clear. Yeah.
The challenge that we face, and we know this, that Africa has not really necessarily been a very big destination for private equity money, especially the commercial ones. Private equity allocation globally, when you look at Africa's allocation compared to the rest of the world, is I think less than 5 or 10%. Africa has historically not necessarily been a destination for private equity. I mean, the commercial ones. What we've actually had mostly are development finance institutions that are looking at Africa from a development point of view. So you would have all the European development finance institutions coming in as the capital providers, and that is what Africa has actually significantly enjoyed. So if we see numbers dwindling from that point of view, it may reflect the changing tides, particularly of these development finance institutions, such as in Europe, which currently now is undergoing its own challenges, and for that matter, are changing the manner in which they want to allocate capital to these endeavors, particularly development endeavors. So that may have impacted the asset allocation that is coming to Africa. Now, of course, generally, the big investors, the big investors that are out there, especially in the US and UK commercial investors, are still not necessarily convinced that Africa is the best frontier for investments. And so you would see that if you bifurcate investments, private equity and venture capital investments coming to Africa, the large portion of that is motivated by development finance institutions. Perhaps that's why that curve is going downwards, as those institutions, by instructions from their countries, are beginning to reallocate. We just this year saw, for example, USA leaving the continent, and with that, a lot of monies that could be channeled towards development efforts also leaving the continent. And other institutions that are operating on the continent perhaps will also are following certain similar patterns, either downsizing and reducing allocation, or actually turning their attention towards something else. What does that mean for African pension funds? Of course, big opportunity. There is space for them to now take over and demonstrate that within Africa we can also generate the capital necessary to fuel our own growth. As we know, we can all admit and accept that we cannot continue to rely on external funding to develop and grow our economies. He who pays the piper, they say, calls the tunes. And so if our investment capital is coming from external, then the tunes will be singing and the songs will be singing are songs that will glorify Europeans and in fact, in these days, China and all those economies who are interested in us for their own benefit and not necessarily for our benefit. So while we sing and dance to their tune, we continue to struggle, we continue to build poor economies, we continue to suffer lack of jobs, lack of infrastructure, lack of innovation, lack of growth. And that is what our pension funds need to look at and say, look, we can step in and call the shots and also sing our own tunes, and let our fund managers and our companies dance to our tunes. And our tunes are the ones designed for us to make progress as Africans or as economies that are looking forward to also rock shoulders with big giants. For now, we stand no chance if we have to compete on technology, for example. How can we compete with China? How can we compete with USA, with their volume of R&D, with their volume of technology? We can't. But then again, it is not in their interest to push you to grow. So our pension funds need to step in. And if that side of investment is going down, it is only a big opportunity for the pension funds to come in and fill that gap and grow the economies the way we want it, not the way DFIs will say they want, or the way Europeans will say they want, but the way Africans want. African solution for African problems. I think that, for me, is a big opportunity for the pension funds. And I hope that, we can collaboratively see that as a positive sign and begin to bridge that gap positively so that we can push our economies forward. Thank you very much, Stanley.
That's a very, very good one. Thank you, Percival. So, I mean, leveraging on what Percival has shared, it means that the pension industry, it's quite important in the scheme of things. And you have been very critical on SME funding. I want to ask you, how important do you think the pension fund is within the SME space? I mean, that's what you've been for some time now. So how important is it? How important is the pension asset within the SME space for you?
Okay, so yes. Can you hear me?
I can hear you now.
Okay, all right, thank you. Yeah, so we've touched on a number of things that the pension funds can be doing to support the SME space and to see that, there's growth within the economy as well. So definitely putting, more investments towards the productive sectors versus doing what they are used to. The understanding that for us to be able to grow our economy depends on us, because there's a lot of internal funding here already which can be used, and also to bring value to the contributors to the pension funds as well. Yes, there's an issue which they raise about the liquidity, etc., and all that. But if you look at it, there are different strategies that the private equity and funds have, which can address some of the issues that they have, whereby they are able to satisfy some of the liquidity issues that they have, while at the same time benefiting from or deriving benefits from the upside with more of the equity type investments where exits there, tends to be bigger. So there's a lot that can be done to Percival talked about the SME gap, which is $5 billion to get that kind of yes, there are some which some are riskier, than others, or the perception is that they are risky. But as we have seen, and Matthew talked about this comprehensively, that there's risk everywhere, but what we want the pension funds to do is to take the step. They are already doing that, but we want to see more from them towards supporting, our local businesses.
Okay, thank you. And first of all, maybe I don't ask this question. You touched on it, and then you can combine. I would combine two questions because of time, and you can respond to them together. And then Matthew also gave his thoughts on that as well. So this is the background to that. So currently, we know that we have 25% allocation to alternatives in Ghana, with 5% allocation allowed to private equity and venture capital. However, it's quite clear as we be discussing that we now have about 1.1% allocation to the space. And there was a research that has been done by CNBC, and they mentioned that about 65% of fund managers in Ghana are really willing to reallocate their funds to PE and the VC by 2026, which seems as a good news for the industry. And there's also a report that was published recently, and it was done by AFCA and the BI. And in their Knowledge Experience Initiative project that they did, they mentioned that there are 4 key pillars that we need to actualize if we want to realize the value we want to see in the pension space. They mentioned data transparency, regulatory reforms, capacity building, and they also indicated that there's a need for deploying blended finance. So I want to ask you, do you think that as a country, for us to be able to maximize the value we want to see, there's a need for any regulatory reforms as a legal practitioner and we're operating in the space? So first of all, that's my question. That's the first one, whether there's a need for any regulatory reforms, and 2, whether you feel that we have the needed capacity built within the country in the pension space to understand how the VC and the PE space operate and therefore allocate funds in that regard. So I don't know if the question is clear because of time. It's a bit loaded.
Stanley, so two loaded questions. First
Yes.
of all, regulatory reforms, and then second, do we have the skill set? Do
Exactly.
we need regulatory reform? I think the answer to both. First, do we need regulatory reforms? Yes, to some extent. Do we have the skill set at the pension industry? We do have some skill set. We don't have enough, and I think that one we need to do that. But let me take them one at a time. Matthew would help me out here. So regulatory reforms. First of all, we've been successful at moving the that 25% allocation. So great. That is fantastic. Fund managers are required to do some registration and licensing with SEC. That process, before you can actually manage pension funds, you have to go through that process. That process seems to have some challenges there. Now, of course, we rely on SEC these days particularly for the diligence they apply to making sure that the right people actually are licensed. So that's a good thing. But the fund itself and its licensing is also required, and there are some challenges there that regulation can actually look at. When the NPRA invited us to make comments on the asset allocation and how that asset allocation can change, there were some other suggestions we made. For example, a fund manager who is going to look for pension funds does not necessarily have to say that they have to put up 2% of the fund size. If he's raising, for example, 100 million, 2% of that fund size in order that he will be able to manage pension funds. I think that regulation needs to be looked at. Beyond that, we need to make sure that it is easier for first-time fund managers to be able to get on the PE radar, because we do not. Matthew said it when the pension funds said that they were ready to invest. And I know I see it when I'm in a capacity building program with them. I see it. We talk, and yes, they seem to be interested in making some allocation. But then they asked me, Percy, over the years, for example, 2025, I've been able to speak to only three fund managers. Where are the fund managers? Where are the asset managers who understand this asset class? They aren't enough. They aren't enough. Matthews, Oasis, Enyonam, Mrepa. They aren't enough. We need at least more fund managers. And so that comes to the capacity building aspect of it. We are trying, at Venture Capital, we are trying. As an industry, we are trying. We do capacity building programs. We have an analyst program to build capacity in the industry. Within the pension fund industry themselves, I think the BII report you mentioned came out of also a 1-year or 12-month training program that pension funds principals and players actually went through for a 12-month period to be trained on the PE asset class. And so there are moves to improve that. Do we have enough? No, Stanley, we don't. Is there room for improvement? Yes. Is the industry doing what it takes to actually build this capacity? Yes. People like Matthew and myself have been at the forefront of doing this for some time. And at every opportunity, we train. In fact, we have even trained service providers, people who are providing services to pension funds, for example, accountants, auditors, lawyers, who are providing services to these institutions so that they can also understand the asset class and that they can not, for lack of knowledge, not become impediments to allocation of the assets. So indeed, capacity building, regulatory reform, we've made suggestions. There are some that are needed. The 25% is great, but we need to make sure that fund managers are capable and are able to run the asset class better. And some of the reporting requirements that our fund managers require. A classic example, and I hope Matthew will expand on this, is that our fund managers are being required to report as the same way as, for example, what do you call this? Collective investment schemes. Fund managers are reporting. Unfortunately, our fund managers are not managing retail investments. They are managing qualified investments. These investors are highly skilled, understand the risk they are taking, and for that matter, we cannot regulate these fund managers in the same way. So some regulatory reform needs to be there. But the capacity building needs to improve, and we are doing a lot in that regard to make sure that that gap is also bridged. So the answer is both yes, but there's room for more improvement. Maybe Matthew can expand on some of those things as well. Thank you, Stanley.
Thank you, Percival. Matthew, I think I'll just allow you to take over from where Percival left it.
Yes, Stanley. I think my previous speakers have spoken quite well on that system. So it is clear that we are evolving as a country. It's a new asset class that we are doing. So we would take a bit of time to get into the fray where we will be happy to see allocation of 5%. But I am sure that practically it's not feasible to have 5% pension fund allocation by 2026. As he has indicated, a few years ago, I would say that more than 15 years ago, when we got ourselves into the space, there were very few PE fund managers. Today, we are seeing a lot more entering, and we are seeing even some of the non-indigenous based ones entering. There's been at that time, there were few transactions. Today, you can count on more than 30 transactions that have been executed. Some exits have been chalked. Some difficulties have been learned, lessons have been learned, and we are day to day seeing experience growing. And it will not be surprising to start seeing that we aggregate the performance within the sector and to drive growth and get people to be highly interested in that space. We need to continue to educate ourselves and to share knowledge and skill such that we will get to the level where there will be a success factor for all of us to consider. I was just reading the side and I saw somebody put up the point how private equity and venture capital are going to benchmark against government securities, and I smile a little because a few years ago, it would have been a very difficult argument to make with your average Ghanaian that government paper carries risk, even though there were several recorded incidents of government having defaulted. And government debt to GDP ratio were pointing to that direction. It was still almost an impossible argument to make. But today, it is clear that every asset class has some risk elements. But we put in mechanisms that will help us to manage the risk that pertains in the private equity space, in terms of governance, in terms of regulation, in terms of compliance, and in terms of raw skill that are needed, because we're sharing knowledge and skill, we are learning from entrepreneurs every day, and that is making us better asset managers as we go on. And we see that we are in partnership with some of the development finance institutions, and also the structure that we've designed is compelling us private equity fund managers to also put a skin in the game. And we will get to a level where the fund managers themselves will be putting significant assets at play, resources at play, and that would help us to sustain the industry and provide an equally competitive asset class for the market to continue to invest in that asset class. Thank you.
Thank you to Matthew, and then it's been a very insightful discussion, and thank you, panel, for your contributions. Before I ask the last question, we've been discussing the impacts that the private equity and venture capital space would have on Ghana if we fully maximize its value, and we also consider the balance between the return and that impact, how we can position the pension assets in the country to realize the values that are hidden therein. We'll also be discussing regulatory reforms required for us to unlock the value we want to see, data transparency, capacity building, amongst other things. Now, my last question to all of you, maybe I would want Enyonam to go first, is that considering the importance of the pension assets in a scheme of things, both for the country and even the pensioners, looking at return and impact, if you are supposed to advise maybe the pension industry as how they should view the private equity and the venture capital space, what would be that singular advice or that single advice that you think you give to them?
Okay, thank you, Stanley. So I would say that they should realize that they are not in this alone, and so collaboration is important. One, collaboration within their own industry as pension funds, because there are some pace setters within the pension funds who have gone ahead to do private equity investments. So learning from them, collaborating with them to learn best practices and ways that they can properly assess the private equity funds. That would be okay. You said one, so I'll say that would be one, that'll be one thing that
you can add one more. You can add one more.
Okay, all right. And then they. I'm sorry. I've just lost my train of thought, but I think I'll leave it there for now.
That's okay. Thank you. So, Percival, your last words on that.
On what, Stanley, please?
On what single advice you will give to the fund managers within the pension space as to how we can unlock the value in the pension industry, which will propel the growth of the country and we create value for the pension holders?
Well, Stanley, my advice has always been that PEVC is not a beast that cannot be understood. It is a transformational tool that actually has driven many economies to the frontiers of success. It has catapulted, economies. Even the US economy has ridden on the back of venture capital and private equity money to generate technology that we all enjoy and we all see, and has given them that #1 position in the world and global affairs. The question that the pension fund manager must be asking themselves is, if you shy away from investing in the productive sectors of the economy as an asset allocator and decide to continuously allocate money to government, then what kind of economy are you actually anticipating that when your contributors go on pension, they would be looking at? Is it an economy where when they get their money, they will not be able to buy anything because the economy is so weak that their purchasing power, despite the fact that you've made some gains from the government treasury bills, is inadequate to actually provide for their needs while they are in pension? Is it an economy where there are no services, and that where indeed you could have had some good healthcare services based out of investments in the past? It is not there. Is it an economy where your grandchildren do not have proper schools to go to because we have actually relegated the investment in our education to, for example, charity-looking organizations? Is it an economy where you cannot simply get out of your house because infrastructure is poor, security is poor, there are no jobs, there is no hospital, there is no education? Is that the economy you want your beneficiaries to actually get into when they go to pension? Or as your responsibility, would you actually put yourself in a position where you can learn first to the point where you now understand the asset class enough to allocate money to the right people and supervise and make sure they deliver the returns that you need? And in that delivery, you would have hospitals that are providing the requisite services, you would have educational institutions, you have infrastructure, and you have the financial return, so that when your contributors go on pension, the economy is flourishing, so that that little money that they can get out of pension can go a long way to meet their needs. That's the question that we must all ask ourselves. It's a profound question for everybody who is actually a pension fund manager. If you decide that you are not going to take a critical look at this asset class, you are also deciding that you are going to stay stagnant and invest and allocate 80% to government. And we know what that can do. Government itself this year has demonstrated that, in fact, it's not even interested in holding it anymore. Because if you give it to government, we are not investing in the productive sectors of the economy. That's why our interest rates currently are coming down, so that they are encouraging more fund managers and more asset allocators to invest in the private, in the productive sectors of the economy. Your responsibility as a fund manager or as a pension fund manager is to invest the time and the resources to build yourself up so that you can understand the PE industry enough to allocate assets and funding to it, enough to monitor performance, enough to choose the right people, enough to choose the right fund managers and to back them so that we can invest in our economies rather than keeping the monies to ourselves and then looking at treasury bills that will not, in fact, push our economy. So that is the kind of advice I would give to pension fund managers. Thank you.
Thank you, Percival. Matthew.
Yeah, my answer and advice to that asset manager will be simple. That the high school that your daughter went to, which enabled her get scholarship to go to Ivy League school, was funded by private equity. The hospital your sister went to yesterday or your wife went to deliver yesterday was also funded by private equity. You should also bear in mind that the bank that you prefer, that you are seeking a mortgage from, had private equity money. The water bottle you pick from the shelf could not have been there but for private equity finance. So it is not a rocket science and it is not a monster. It is the day-to-day provision of capital to support our daily life and businesses that is dotted around us. And the employment that your brother is seeking and the company he went to for interview yesterday would not have existed but for private equity capital. So in short, what I would say is that we are providing financing to finance the growth of our economy and to prepare the sustainability and development of our dear nation. And we want all of you to be part of that process. Thank you.
Thank you. Thank you. I think it's been a very insightful discussion, and personally, I've learned how to, appreciate the role the pension industry can play to unlock the value that we intend to see in Ghana's economy. So thank you so much for that insightful contribution. We really appreciate your time. So let me give some time for questions. So if you have a question, you can actually just maximum 10 minutes. We should be done. So I think I have one question here. You can direct this question to Matthew and Enyonam. So Matthew and Enyonam, I have a question for you. Maybe Matthew will go first and then Enyonam will take over. So the question is, Mirepa and Oasis have achieved what's often seen as the toughest milestone, bringing pension capital into private markets. What were the biggest hurdles you faced? What differentiated your pitch to trustees? And what practical advice would you give to emerging fund managers who want to tap into the same pool of funds? I don't know if the question is clear.
It is tough, but it is clear. Yes, as I indicated earlier, because it's a new asset class in our environment, we needed to do high-level conversation on several occasions for people to appreciate. We needed to tell the story about success and story about failures and story about the lessons learned, and to demonstrate that it is not a monster, it is not a rocket science, it is a normal financing of businesses within our environment and space. And we try our best to make it tangible to people to appreciate that we have funded schools, we funded hospitals, we funded food production, we funded housing, we funded hotels, we funded infrastructure. And all these things carry risk, but we have the capacity and the resources that are required to manage them. And also demonstrate that in other jurisdictions, they have done the same, and that led to the development of those nations. And if we demonstrate that, and more importantly, there has also been significant improvement in the regulatory environment, because in Ghana, the quick thing that people would ask is, how do you manage against bad behavior? And indeed, if you don't manage it well, there could be bad behavior. But I think there's been significant mechanisms and safety systems that have been put in place from the regulatory standpoint and from the institutional establishment and development point to ensure that the people that deliver or are entrusted with this resource to manage conduct themselves very well. And two, also demonstrate that they have the competencies or they are willing to employ and go onto the continent to tap into talents that are required to ensure success within the space. So it wasn't easy, but it was based on the points of demonstrating that indeed it has been done and we continue to improve day after day. And that is what took the balance. Thank you.
Thank you too. And then I'm sure we want to also hear your experience as well.
Okay, so I missed the part of your question, but my understanding is that the question is about how we succeeded in raising funds from the pensions funds. Is that correct?
Exactly. So you're saying that what often, okay, I mean, you have achieved a very good toughest milestone. So what were the biggest hurdle you faced, and what differentiated your pitch to trustees, and what practical advice would you give to emerging fund managers who want to tap into the same pool of fund that you have?
Okay. So we we're a first-time fund manager. I hope that you can hear me clearly.
We can hear you. Go ahead.
All right, sure. Thank you. Yes, so as I was saying, we are a first-time fund manager, so we had to jump over. So we needed to build trust with the trustees and with the pension funds. We needed to have a lot of conversations with them, and both at the fund level, fund manager level, and then the contributors to the funds as well. And we used our track record of having built businesses as one of the foundations as well, because in private equity it's very important to show that you can actually add value to the business that you are investing in. It is not just about giving them money, but how that investment that you make in the business can be utilized to grow the business. So it was important that we used our experience from having worked in local SMEs and built these SMEs as well. And then we also need
I think we've lost you.
to give comfort to the that we were working with. And so, hello, is it okay now?
Yeah, it's better now.
Okay, all right, let me try and be fast. And so the strategy that we also used was to give them some comfort as well. So we used some self-liquidating instruments that can return capital very quickly to the pension funds, which is what they are used to. And then we also needed to indicate or show them that we could make the right investments. So in our selection of the SMEs as well, we needed to indicate to them that we could pick the right entrepreneurs to back. And then a big part of that was also having the venture capital trust fund be our anchor investor. And so they led the way and opened up for the pension funds to Hello, Stanley.
Yes.
Hello, Stanley.
I think Stanley went off, so maybe.
Yeah.
Oh, okay. Okay,
I
maybe
think we
Isaac
lost
can.
Stanley for a bit.
Hi, sorry.
Yeah.
I
Okay.
was sorry. Saying there's a question I have here, and then the person says that many of our CF members listening today might be thinking, this space sounds exciting, but where do I even start from? If I want to manage a VC fund someday, what practical steps or support mechanisms exist to help them build the right skills, partnerships, or track record, particularly from VCTF, Venture Capital Trust Fund? So, first of all, I think they're asking how, as I mean, beginners, how can we tap into that in the space you're operating in, basically?
Thank you. Maybe this question is more appropriately within the domain of Matthew, but I'll attempt an answer. I mean,
Okay, then let's allow Matthew to take it. I don't mind.
Okay, let Matthew take it, and then I can support if it's
Okay, sure.
necessary.
All right,
I
sure.
think it's you just like many other things, you would have to start by learning, and learning by doing it is known to be the best form of learning. For example, we have it that we do not invest in startups unless the startup is established by an experienced team or group of people who have skill set in a particular sector. So the first thing is that you have some skill set, you find some existing private equity practice on the continent to learn from and gain some experience. Or you could also have learned skills by just being an entrepreneur and having done something. So that, because being private equity practitioner means that you also must have some entrepreneurial skills within to be able to provide appropriate support to guide businesses, because we are dealing with business at the executive level and also at the operational level. So your own skill and experience is very necessary. It's not feasible to just get out of school and set up a shop and say you are doing private equity practice. So that is the way to go. And I think the VCTF itself has embarked on a program which is providing training for analysts. So you first take a shot at how to analyze a business, how to run a financial model, how to ask a relevant question, how to take a bite at due diligence, and to be able to avert adverse selection, and also how would you detect moral hazard, quite a number of risk factors. So that is a process of learning. And I think there are a number of institutions from whom you can learn, and a number of people that you can learn to gain that experience. So that young, aspiring private equity practitioner, there are several avenues for you to start your process. It's a journey which you must walk. Thank you.
Stanley, let me just add very quickly.
Okay,
in addition
sure.
to what Matthew said about the venture capital analyst program, anyone looking to enter the industry, we usually open up calls for application at the beginning of the year. And we go through that selection process until we finally get the cohort in April. It's just 10 people, just 10 young analysts that can get in. Usually when we open, we have about 500 people. So if you want to get into that program, you better keep an eye out there and prepare yourself for it. That's one aspect of getting into the industry. We are also coming up with what we call the Fund Manager Development Program. There have been some slight delays in rolling out that one, but when we do, that's also a full comprehensive 6-month program that is designed to train ready and eager young financial persons who want to get into the industry. So in addition to actually joining a firm, you could take advantage of these specific programs to get into the industry and to learn. But I mean, what I will also add is wherever you are, because private equity has very long arms. It stretches to encompass a lot of things, because as an investor, you might come across many industries, many opportunities, many situations, many challenges. So wherever you are actually building yourself to understand some of these things, because even if you find yourself at the operational level, i.e. that you are an entrepreneur yourself, or that you are an advisor, or that you are into M&A, or that you are into, for example, even trading or whatever, wherever you find yourself, you are learning skills that are transferable in private equity, because we will need that skills when it comes to, for example, advising companies. So it is good if you have an eye to get into private equity, that you also hone those skills and look at for an opportunity to get in and contribute those skills to a fund management establishment. That's what I'll add. Thank you, Stanley.
Thank you so much, Percival, Enyonam, and Matthew. We really appreciate your time. So we come to the end of the panel discussion. I'll hand over to James to give us a concluding remark.
All right. Thank you, Stanley. And good afternoon, everyone, for joining this call. First of all, we want to, on behalf of the CFA Society, extend our gratitude to all who are on the call, and especially to our panelists. That's Percival, Matthew, and then Enyonam. We believe that these conversations are not just meant to die here, but they are conversations that will lead to greater effects on our markets and then our economy. And most importantly, for the end of pensioners that are, will be enjoying some of this, the output of these conversations in some years to come. We would want to encourage, others who are on the call to also, as and when you believe that there are other topical issues that we can handle to advance the growth of our markets, you would kindly reach out to the society, and we take it from there. Also, we want to thank the CFA leadership, Society Ghana leadership, and all the planning committee members, our panelists as well, Stanley. And this specifically for the members, that is the CFA Society Ghana members. This particular webinar counts for a 1.25 PL credits for you. And then also for the QR code that we can see there, that is the scan me, kindly scan it, then give us your feedback. And then you give us ways that we can, improve upon the webinars that we hold, and then the topics that we pick, and then also the resources that you believe that we can bring to enrich our markets and then the growth of our economy as well. Thank you very much, and I would hand over to Ifriye.
Thank you, and enjoy the rest of your day.
Okay. Thank you. Bye.
Yeah, thank you. Bye.